Most people think becoming a millionaire requires a six-figure salary, a startup, or winning the lottery. But what if I told you that one of the most reliable paths to wealth doesn't start with a big paycheck, it starts with just $500 a month? It sounds almost laughable. $500 isn't enough to cover rent in most cities. It isn't even enough to buy a new car. And yet, with the right approach, discipline, and understanding of human psychology, this seemingly small number can grow into a life-changing fortune. We're not talking about get-rich-quick schemes. We're talking about a strategy that taps into the hidden power of compound growth, delayed gratification, and mental frameworks that separate the wealthy from the perpetually paycheck-dependent. The uncomfortable truth is this: most people will never try because $500 feels insignificant. But history, and human psychology, suggests that significance is an illusion. What matters is consistency, strategy, and mindset. My name is Aiden. Let's start by examining why $500 a month seems small, and why that's exactly why it works. Humans are wired to overvalue the immediate and undervalue the future. Psychologists call this present bias. We'd rather spend $50 today on a fancy dinner than save $50 for retirement 20 years from now. It's not laziness, it's biology. Your brain literally rewards immediate gratification more strongly than delayed rewards. But here's the catch: the very thing that makes small contributions feel irrelevant is also what makes them powerful over time. $500 a month may feel tiny, but compounding doesn't care about how small it feels. Compounding is indifferent. It only cares about consistency and time. To illustrate, imagine two people. The first invests $500 every month starting at age 25. The second waits until 35 but invests $1,000 a month. Most would think doubling the amount later would catch up, but it doesn't. By age 55, the first person ends up with almost twice as much. This is the subtle, almost unfair magic of starting early and trusting the process. But psychology isn't just about understanding money. It's also about habits and perception. $500 is small enough to be non-threatening, which makes it easier to commit to. Your mind doesn't rebel against small sacrifices, and that's the key to building momentum. Momentum is the hidden currency of wealth building. And momentum doesn't just accumulate in your bank account. It changes your identity. When you consistently invest $500 a month, you stop thinking like a consumer and start thinking like an investor. You stop seeking instant thrills and start seeking long-term wins. That shift, psychologists would say a shift in your behavioral identity, is what separates millionaires from the majority. Finally, there's another layer most people overlook: the emotional edge. When you commit to small, consistent actions, you're training your brain to tolerate delayed gratification. You're rewiring your impulses, slowly but surely. That's the true invisible wealth that compounds alongside your money. By now, $500 doesn't feel so small anymore. It feels like a lever, a tiny, daily push that can move mountains over time. And understanding that psychology is the first step before even touching a single dollar. Now let's talk about the part that makes this plan work: the math. Because the truth is, becoming a millionaire with $500 a month isn't about saving money. It's about buying time. Imagine investing $500 every month into a diversified investment portfolio, something simple like broad stock market index funds. Historically, the US stock market has returned about 7 to 10% annually on average after inflation over long periods. Now let's run a simple scenario. If you invest $500 every month for 30 years, and your investments grow at around 8% per year, you end up with roughly $745,000. Not bad. But here's where things get interesting. If you stretch that timeline to 35 years, that same $500 per month grows to around $1.1 million. Notice something important here. You didn't suddenly start investing more money. You didn't find a secret stock. You didn't build a company. You simply let time do the heavy lifting. And this is where most people misunderstand wealth. They think wealth is built through huge financial moves, massive salaries, lucky investments, or viral businesses. But in reality, most millionaires are created through something far less exciting: boring, automated, consistent investing. Think of it like planting a tree. The first few years feel pointless. You water the soil, but nothing dramatic happens. The tree is small. The progress is invisible. But underground, something powerful is happening. The roots are spreading. The structure is forming. And then one day, years later, the tree suddenly looks massive. From the outside, it looks like rapid growth. But in reality, it was decades of quiet compounding. Money behaves the exact same way. In the early years of investing, your contributions matter more than growth. But later, something flips. The compounding becomes so powerful that the growth starts contributing more than you do. At that point, your money is no longer just saved, it's working. For example, when your portfolio eventually reaches $500,000, an average 8% year could generate generate $40,000 in growth. That's more than your entire yearly contribution. And when it reaches $1 million, that same growth rate can produce $80,000 per year without you adding a single extra dollar. This is the moment most people never reach. Not because it's impossible, but because they quit during the slow phase. They stop investing after a few years because the numbers look small. They get distracted by short-term spending, market crashes, or the illusion that wealth requires something dramatic. But the truth is much simpler. The $500 plan works because it removes drama from the equation. You automate the investment. You ignore the noise. And you let decades quietly transform small monthly deposits into serious wealth. But there's still one huge problem with this strategy. And it's the reason most people never follow through. Because knowing the math is easy, sticking with the plan for 30 years is the real challenge. And that challenge isn't financial. It's psychological. Knowing the math is easy. The real challenge is surviving your own psychology. Because the biggest threat to the $500 a month millionaire plan isn't inflation, it isn't market crashes, and it isn't even a low salary. It's human behavior. Most people don't fail because the strategy is wrong. They fail because their brain is wired to sabotage long-term plans. And this usually happens through three quiet psychological traps. Trap number 1, that nothing is happening phase. The first trap appears in the first 5 to 10 years. You're investing every month. You're doing the right thing. But the numbers feel disappointing. After 3 years, maybe you've accumulated $20,000 or $25,000. After 5 years, maybe $40,000 or $50,000. It feels small. Your brain compares it to things you could have bought instead. A car, vacations, new gadgets, and suddenly the investment feels slow and unrewarding. But here's the psychological trick. The early years are not about growth. They're about building the machine. Compounding is slow in the beginning because the base is small. It's like pushing a giant flywheel. At first, every push feels pointless. But once it gains momentum, it becomes almost unstoppable. The people who become wealthy aren't necessarily smarter. They're simply the ones who survive the boring phase. Trap number 2, the market panic. At some point during those 30 years, the market will crash. Not maybe, definitely. Stocks will fall 20%, sometimes 30%, sometimes even more. The news will be dramatic. Headlines will say things like, markets in turmoil, investors panic, economic uncertainty, and suddenly your portfolio, something you spent years building, starts shrinking. This is where most people abandon the plan. But here's the strange paradox of investing. Market crashes are actually the moment your $500 becomes most powerful. When prices fall, your monthly investment buys more shares. It's the financial equivalent of a massive sale. But our brains don't see sales in the stock market. They see danger. That's because humans evolved to avoid losses, not embrace them. Psychologists call this loss aversion. The pain of losing money feels about twice as strong as the pleasure of gaining it. Which means investors often sell at the worst possible time. The millionaires do the opposite. They quietly keep investing, month after month. Trap number 3, lifestyle inflation. The third trap is the sneakiest. It happens when your income starts rising. You get a promotion, a new job, a raise. Suddenly, $500 a month feels unnecessary. You could upgrade your car, move into a nicer apartment, spend more freely. And slowly, the investing habit disappears. Not because of hardship, but because of comfort. Psychologists call this the hedonic treadmill, the tendency for humans to quickly adapt to better lifestyles and then crave even more. Income rises, expenses rise, and the gap between them stays the same. But the people who reach financial independence do something different. Instead of increasing their lifestyle every time their income grows, they increase their investments. The $500 becomes $700, then $1,000, then more. Not dramatically, just gradually. And that simple decision can accelerate the millionaire timeline by years, sometimes decades. So by now, the real truth of the $500 a month plan should be clear. It's not just a financial strategy. It's a behavioral strategy. It works not because it's flashy, but because it quietly aligns with how wealth actually grows. Slowly, consistently, and often invisibly. But there's one final piece to this puzzle. Because the people who actually become millionaires with this method don't just follow the plan. They follow one powerful rule that makes the entire system almost automatic. And once you understand it, the plan becomes far easier to stick with. At this point, the $500 a month millionaire plan might sound surprisingly simple. Invest consistently. Ignore Ignore short-term noise. Avoid psychological traps. But simplicity creates a new problem. If the plan is so straightforward, why don't more people succeed with it? The answer comes down to one powerful rule that separates the people who intend to build wealth from the people who actually do. Automation. Because the biggest enemy of long-term investing is decision fatigue. Every month, your brain has to choose. Should I invest this money, or spend it? And when that choice exists, something interesting happens. There will always be a reason not to invest. A new phone, a weekend trip, an unexpected expense, a reward after a stressful week. One skipped month turns into three turns into a year, and eventually the plan disappears completely. But automation removes the decision entirely. The money moves before you even see it. The $500 leaves your account automatically and goes straight into your investments. No debate, no hesitation, no willpower required. And this tiny structural change transforms the plan from something fragile into something almost unstoppable. Behavioral economists sometimes call this designing for success. Instead of relying on motivation, you build a system that works even when motivation disappears. Because motivation fades, systems don't. Think about it like brushing your teeth. You don't wake up every morning and debate whether brushing your teeth is worth it. The habit is automatic. Wealth building works best the same way. Once the system runs quietly in the background, something remarkable happens. Years pass. Your career evolves. Life gets busy. The world changes. But that small, consistent investment keeps happening every single month. And one day, almost unexpectedly, the numbers start to look very different. The portfolio crosses $100,000, then $300,000, then $700,000, and eventually, that quiet habit, the one that once felt insignificant, crosses the seven-figure mark. $1 million. Not from one big decision, but from thousands of small ones that happened automatically. That's the real secret of the $500 a month millionaire plan. It doesn't rely on brilliance. It doesn't require perfect timing. It only asks for three things: consistency, time, and the patience to let compounding do what it has always done. Turn small beginnings into extraordinary outcomes. And if there's one idea from this video worth remembering, it's this: wealth is rarely built in dramatic moments. It's built quietly, in the background, while most people are busy looking for shortcuts. If you found this breakdown useful, consider subscribing for more deep dives into the psychology of money, habits, and long-term thinking. Because sometimes the smallest monthly decisions shape the biggest parts of your future.